Hey there, fellow traders. Ever wonder what makes or breaks a successful trade? Sure, strategy and analysis are key, but there's a secret sauce you can't ignore. Liquidity. Think of it as the oil that keeps the engine of the market running smooth. Without it, your trades are dead in the water. That's the power of liquidity. And today, we're diving deep into how to harness it for maximum profit. Let's cut to the chase. Liquidity is simply how easily you can buy or sell an asset without moving the price. High liquidity? Think Apple stock. Millions of shares trade hands daily, so you can buy or sell a chunk without causing a ripple. Low liquidity? Imagine trying to offload a rare vintage comic book. Finding a buyer takes time, and you might have to lower the price to get a bite. See, liquidity is all about the ease of trading. It's the difference between a smooth transaction and a frustrating ordeal. Now, why should you care about liquidity? It's a crucial concept that can make or break your trading experience, because it directly impacts your bottom line. First off, let's talk about the bid-ask spread. This is a fundamental aspect of trading that every investor should understand. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. In highly liquid markets, this spread is usually very tight. High liquidity means a tight spread, saving you money on every trade. This is because you are able to buy and sell at prices that are very close to each other, minimizing your costs. Low liquidity? Get ready for wider spreads that eat into your profits. When the market isn't liquid, the difference between the bid and ask prices can be significant, leading to higher costs for you. Then there's slippage. Picture this. You see a stock dipping and hit buy, but the price you actually get is worse. This happens because the market moves quickly, and your order can't be filled at the expected price. That's slippage, and it's more common in illiquid markets. When there aren't enough buyers and sellers, prices can change rapidly, making it difficult to execute trades at desired prices. Finally, let's talk about trading costs. Brokers love to charge fees, and these can be higher for illiquid assets. When you're trading in a market with low liquidity, you might find yourself paying more in fees and commissions. High liquidity equals lower costs, putting more money in your pocket. When the market is liquid, you can trade more efficiently and at lower costs, which ultimately benefits your bottom line. See, understanding liquidity isn't just academic, it's about protecting your hard-earned cash. By being aware of how liquidity affects your trades, you can make more informed decisions and optimize your trading strategy. So how do you use liquidity to your advantage? Let's talk strategy. First up, stick to highly liquid markets. Think major stock indices, popular ETFs, or heavily traded currencies. These markets offer tight spreads, minimal slippage, and ample opportunities to enter and exit positions with ease. It's like cruising down a highway with minimal traffic. Next, beware of low liquidity. Avoid thinly traded stocks, especially penny stocks or exotic options. These markets are like treacherous backroads, full of hidden dangers and unexpected bumps. One wrong move and you could be stuck with an asset you can't sell. Remember, safety first. But wait, there's more. Liquidity isn't static, it fluctuates throughout the day, week, and even year. And guess what? You can use this to your advantage. Ever notice how markets get choppy near the opening bell or before a major economic announcement? That's liquidity drying up, creating more volatility. Best to steer clear unless you're a seasoned pro. On the flip side, midday trading often sees a surge in liquidity, especially in major markets. This is your sweet spot for smooth execution and minimizing slippage. Remember, timing is everything in trading, and understanding liquidity patterns gives you a serious edge. Ready to take it up a notch? Let's dive into some advanced liquidity concepts. First up, stop-loss hunting. This is where institutional traders intentionally drive the price down to trigger stop-loss orders and then buy at a discount. Brutal, right? But by understanding liquidity dynamics, you can avoid these traps and even turn them to your advantage. Then there are liquidity zones. These are price levels where large orders are typically placed, creating pockets of high liquidity. By identifying these zones, you can anticipate price movements and optimize your entry and exit points. Remember, knowledge is power, especially in the fast-paced world of trading. Section 7. Crypto and liquidity pools. Now let's talk crypto. The world of cryptocurrency is vast and ever-evolving, with new opportunities and challenges emerging every day. One of the most exciting developments in this space is the rise of decentralized finance, or DeFi. DeFi is revolutionizing the way we think about finance by removing intermediaries and giving power back to the people. The decentralized finance or DeFi world is all about liquidity, but it works a bit differently here. In traditional finance, liquidity is provided by centralized institutions like banks and exchanges. However, in the DeFi ecosystem, liquidity is provided by the users themselves, creating a more democratic and accessible financial system. Instead of traditional exchanges, DeFi uses liquidity pools. These pools are collections of crypto assets locked in smart contracts, which facilitate trading on decentralized platforms. This system allows for continuous and automated trading without the need for a central authority. These are smart contracts that hold crypto assets, allowing users to trade directly with the pool. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. They ensure that transactions are secure, transparent, and tamper-proof. The more assets in the pool, the higher the liquidity. High liquidity means that trades can be executed quickly and with minimal price impact, which is crucial for a healthy and efficient market. Traders can profit from liquidity pools by providing liquidity themselves, a process called yield farming. Yield farming involves lending your crypto assets to a liquidity pool in exchange for rewards, usually in the form of additional cryptocurrency. By lending their crypto to the pool, they earn a share of the trading fees. These fees are distributed proportionally based on the amount of liquidity each user provides, creating an incentive for more users to participate. It's like becoming your own mini bank. You have control over your assets and can earn passive income by simply providing liquidity to the pool. This democratizes finance and opens up new opportunities for individual investors. However, DeFi is still evolving and risks abound. Smart contract vulnerabilities, market volatility, and regulatory uncertainties are just a few of the challenges that users may face. It's important to be aware of these risks and take steps to mitigate them. So do your research and understand the technology before diving in. Educate yourself about the platforms you use, the assets you invest in, and the potential risks involved. Knowledge is your best tool in navigating the exciting yet complex world of DeFi. Section 8. Tools for tracking liquidity. Don't worry, you don't have to be a rocket scientist to track liquidity. With the right tools and a bit of practice, anyone can become proficient at it. Plenty of tools can help. First up, volume analysis. This is one of the most fundamental methods for tracking liquidity. By examining the volume of trades over a specific period, you can gauge the level of interest and activity in a particular stock or asset. High trading volume usually indicates high liquidity. When you see large volume bars on a chart, it means that many shares or contracts are being traded, which generally makes it easier to enter or exit positions without significantly affecting the price. Look for stocks or assets with consistently strong volume, especially during specific trading hours. For instance, the opening and closing hours of the market often see higher volumes, providing better liquidity. Then there are order books. These are essential tools for any serious trader. These show the buy and sell orders placed for an asset, giving you a real-time snapshot of market depth. By analyzing the order book, you can see where the majority of buy and sell orders are clustered, which can help you predict potential price movements. A deep order book with many buy and sell orders close to the current price signals high liquidity. This means that there are plenty of participants willing to trade at or near the current market price, making it easier to execute large trades without causing significant price changes. Finally, we have liquidity heat maps. These are advanced visual tools that provide a comprehensive view of liquidity across different markets and assets. These visual tools display liquidity across different markets and assets, helping you quickly identify the most liquid trading opportunities. By using heat maps, you can spot areas of high liquidity at a glance, making it easier to decide where to focus your trading efforts. Remember, the right tools can make all the difference in making informed trading decisions. By mastering volume analysis, order books, and liquidity heat maps, you'll be well on your way to tracking liquidity like a pro. Section 9. Common liquidity mistakes. Even seasoned traders can stumble when it comes to liquidity. Let's look at some common mistakes to avoid. First off, ignoring liquidity altogether. Many beginners focus solely on price action, forgetting about the importance of smooth execution. Big mistake! Next, trading during low liquidity periods. Remember those choppy market openings? Unless you're an adrenaline junkie, it's best to sit those out. Then, there's overtrading. Even in liquid markets, placing excessively large orders can lead to slippage and impact prices. Finally, not using stop-loss orders. These are crucial for limiting losses, especially in volatile markets. Remember, trading is about managing risk, and understanding liquidity is a big part of that. Section 10. Dive into the liquid world of trading. So there you have it. Liquidity is overlooked but essential ingredient for successful trading. By understanding how it works, the strategies to employ, and the tools to utilize, you can navigate the markets with confidence and maximize your profit potential. Remember, knowledge is power, and in the ever-changing world of finance, staying ahead of the curve is key. Now go out there and make some waves. Subscribe and share for more interesting videos.